Thank you so much, leaders, for joining us on another podcast at Dawdle.live. Today, we have got another special guest with us. His name is Mr. Kaushik Banerjee. Enormous amount of experience in various industries. We have got very interesting set of topics for him as well. But before we go there, would love to understand from Sir his journey so far and his experience so far, maybe in a brief.
So last 23, 24 years, I have spent in the banking and financing space, primarily into lending. I started my career with Citibank and then 4 years in Standard Chartered. Then throughout it was NBFCs and especially very large NBFCs like Tata Capital. I spent 9 years. I was the pilot, team member while the policies were launched, the products were launched, and pan-India geographies were opened up. Then Hero FinCorp in 2016, again for the SME lending space, it was very new, and I was again in among those leaders who had started the entire thing. Similarly, UGRO in 2001, and now with Solfin, I have spent a small stint in DMI Finance, DMI Housing Finance to be precise. So yeah, overall 23, 24 years of thorough credit experience across products, secured, unsecured, mortgage, project finance, supply chain, machinery finance is what I have primarily done.
Thanks so much, sir. And we can see that your career spans across these large banks and fast scaling NBFCs with a very deep exposure across MSME, supply chain finance, housing, and equipment finance. If you kind of, think back, do you recall, the moments which most shaped your evolution as a credit leader?
Well, of course. See, the idea of acquiring something is a little different, and experiencing something different is uh, is what enriches your overall learning and growth both, right? So for all, as an individual, when they start their journey in the corporate side, and when they are in a smaller loans like a credit manager or an appraiser or a regional manager, till that time maybe you do not get to see the holistic picture of how an organization is running. That kind of a role was first in Tata Capital in 2007-8 when Tata Capital was launched, and we were a team of 10, 12 people who were managing the entire show across all products. So that is where I started getting to know more on how to design a product, how people think in terms of collection, operations, customer satisfaction, the entire end-to-end journey. So in Tata Capital, I did learn a lot in the 9 years on the commercial side. Before that, I was with Standard Chartered Bank, primarily looking into retail loans, home loan, LAP, personal loans, kind of stuff. Even with ICICI Bank, I had spent a year again in home loan and LAP. Now, the real growth journey began from Tata Capital and in Hero FinCorp, while I spent 5 years as head of credit for all SME products, supply chain especially, and then small ticket loans, machine finance. So those are times when we saw that actually how businesses happen, that kind of an understanding of what business generates, what kind of a cash flow, whether it's absolutely same throughout the year, what is the percentage of cash flow into, the EBITDA margins and all. So in Tata Capital and Hero FinCorp, I have deeply seen geographies, kind of businesses, SMEs, especially because NBFCs being NBFCs, they, tend to give smaller ticket loans, which is where NBFC, survival is there, right? A little higher pricing than banks, faster turnaround. So I have learned a lot in my Tata Capital days and Hero FinCorp days, because that time, 2007, 8, 10 till 14 or maybe 20, the entire space was developing. The government came in, pitched in for more and more SME. Make in India happened, and the journey was a little patchy as well, I would say. Back in 2016, Demon happened, right? So the entire journey of SMEs tumbled up for once, especially in particular pockets like Gujarat and Punjab, some pockets of South like Coimbatore and all, because there the cash transactions were the model of business. Tax evasion was a model of business. Early in 2017, again, GST happened. A lot of things changed, right? In 2020, 21, we all know COVID came. Small businesses, many of them, couldn't survive the test of time, while many of them sailed through, who had strong, business model, who have strong understanding and control over their cash flows. So those are days where my learning was on the peak, I would say.
Must say, sir, these are such kind of challenges which nobody can actually predict.
Correct.
And that is where the actual leadership comes out, within the company. Were you like kind of amazed, or were you kind of taken aback when these crises were happening, like right from 2016 to 21? So how was the morale of the team, sir? How did you manage to keep the morale high, make sure that the processes do not suffer and all those things?
Right. In fact, it all started with Lehman Brothers back in 9, 10. The infra going down, infrastructure finance as a business vertical completely shattered uh, due to multiple challenges. So at that point of time, I mean, we had a very senior guy who called me one fine day. I was a little worried. God knows what is going to happen, whether we survive, whether we will be washed out or not. So he said, see, one thing you need to ensure is, first thing you will have to digest that, okay, this has happened. Now COVID has come, so COVID has come, right? If let's say infrastructure finance was not doing well due to whatever reason, or a GST is implemented, or a demonetization was done, so it was done. First thing that you need to adjust and digest the fact that, okay, this has happened. Now
Yes.
let's start thinking what or how, when can we kind of come back into shape. So the first and most important thing what I feel is that the market, the economy is dynamic and changing every day.
Mm.
I mean, couple of months back, look at what Trump did to India in terms of tariffs and stuff. So the exporters market is was completely under question mark, right? Pharmaceutical being one of the largest and one of the best performing industries for India also was questioned. But today things are looking a little different. People find out solutions. So first thing I sincerely feel is that we need to digest the truth that, okay, this is what has happened, and then you need to fight back, come back with a strategy, with a policy that, okay, these are retail loans which I'll do going forward. These are loans which I'll not do going forward. Especially people who are dependent on tax evasion as a model of cash flow generation, or cash as a model of cash flow generation. We then took a call that, okay, we need to have some fallback arrangement in terms of security, or a lower tenure, or whatever, right? So every time you think of doing a business, you need to also ascertain and make sure that there's a fallback that is available. So COVID, not just COVID, there are other downturns also which taught us all this, and it was exciting. I would say initially, yes, it was a shocker for everyone, but with time, I think the way entire industry has come back into shape is really good.
Sir, I think the kind of a career you have, like 23 years, I think you have seen maximum number of crises per unit year, I think. So I was
Yeah,
calculating.
24. I started in 2002, and today is 26. So just completed 24.
Also we see that, as the portfolio size changes, so you have handled, portfolios ranges ranging from 1,000 crores to 3,500 crores. So as this change, how does a credit leader's mindset also changes?
So, this entire business is about lending money to people or organizations, where obviously there are again people on the other side, right? So, first thing that I feel that one should be very, very sure about is the right hires, right?
Hmm.
If you have the right set of people,
Hmm.
they only are getting you the business, they are doing the monitoring, they are maintaining the relationship, especially on the working capital side, like, trade finance or supply chain. So having the right set of people and people stability, both are
Hmm.
extremely important. Second, of course, the process, the kind of policies that you implement on day one, it may work, it may not work, right? The
Hmm.
expectations keep changing. So the people stability and the process stability are two most important things for any credit leader, or organization, even for the CEOs. I would say that people stability and process stability. Once you reach there, it takes time. It doesn't happen overnight. Maybe for newer organizations who are starting with a common set of people coming from other entity to this entity, might still have a shorter
Yes.
span
Hmm.
to reach to that stable kind of scenario. But then mostly it takes some time. It takes average 1.5 to 2 years is what I have seen, right? So people stability, process stability, and then there has to be a feedback loop where we are going wrong, where we can do better.
Hmm.
You keep your eyes and ears open, keep looking at competition, keep looking at other stuff, keep looking at customer requirement
Right.
first, and most important is customer
Yes.
requirement. People and what competition is doing is maybe second or third. Yeah. So these are three, four key aspects: people stability, process stability, feedback loops, and of course, keeping your eyes
Customer.
and ears open.
So you were talking about customer interests. So, when it comes to credit, governance and growth both are very important. So,
Correct.
where do you think most of the organization is still struggle to truly align risk and growth?
See, what I feel is every organization, like a UGRO or a Tata or a Hero, they all started with a vision. Every organization first make a vision statement. That's fine. That's absolutely fine. And people follow that. But within the first, second, third year of operations, they normally come across various challenges, people challenges, geography challenges, unseen challenges like COVID and stuff, which we just discussed. These challenges now keep changing tracks every time. So after 2 years, 3 years, one CEO might feel that, okay, this is not working. So what next? So those changes has to have a balance. Risk and return is a formula which everybody knows. I keep telling my credit folks that a plus b whole square is equal to a square plus b square plus 2ab. This everybody knows. But how fast can you do it? How fast can you adapt it? Right? Is what makes you different from the others. So the risk and return balancing activity has to be done not just by credit. It has to come from the investors also. So if let's say the board itself just want a top line number in first year, second year, third year, you may still achieve it, but in the long run, that may not be a sustainable business. I mean, let's talk of a very large private sector bank which struggled till maybe 2007 8. Now it has stabilized, and I'm talking of the largest private sector banks in India today. So yeah, they acquired something in Russia, something in Rajasthan. Things were absolutely turbulent. I was there in that particular bank at one point of time. It used to happen that month end where some guys are coming with 80 files, and overnight you are doing a sanction as well as sanction letter and dispersal, everything in next 4 hours. So obviously there will be no quality. But then people stabilized. I mean, people realized that probably this is not the best way to do it, and they kind of reined the entire team back. They shaped up really well. Today they are the top among the top. I would say. So it matters how the management is thinking. Management is not just the CEO. It has to be the CRO, the chief credit officer, the collection, the uh, uh, you know business, especially people who are sourcing. So there has to be a level of transparency that everybody knows with what unit economics organization is going to make money and how far is it sustainable. If I'm, let's say, just to close down a couple of my NPAs, doing a very hard settlement at 40-50% write off, then my going forward LGD will go for a toss, and which is not a sustainable model. So the entire, alignment of the team, I think that kind of a transparent culture is important, where all stakeholders, be it credit, be it risk, be it collection, business, are brainstorming together that, okay, this is what is sustainable, this is what can sail through for long, and then it becomes really, really stable.
Sir, I remember one incident. Like, I was working for a company and we had tied up with a few BNPL providers, and they were also young in the market, and they used to give credit like left, right, center without, kind of taking, kind of considering the civil scores and all that.
Let me be very honest, everybody has done it at one point or other, even large banks.
But after 2 years, sir, what happened is that then they became more serious because they thought that, this is not working out for them. There's a lot of defaults that were happening. Do you think this happens all across, sir? Like,
Initial days, yes, when the entire organization is learning, these are phases which yes, the degree might vary.
yes.
20 is what they say in Hindi, but
Ah.
then the degree might vary. But yes, these are phases which every organization goes through, at least in the initial 3, 4, 5 years.
Sir, across your this vast experience of 22, 23 years, what are the most common credit mistakes that you see lenders make while they are choosing rapid expansion?
See, credit psychologically, credit folks, they believe that there's something called a CAM, credit approval memorandum, right? It's an internal note which the credit guy prepares, sends it for approval, or approves it on its own if it's prepared by his team. Now that CAM is something that credit guys own. Most of the time, I have seen in the last over 2 decades that the culture becomes such that entire credit top bosses to people in the customer facing segment also try and decorate that CAM so that nobody can find a mistake. But that mistake, I mean, doing this activity, that if I have recommended or I have sent a CAM, it should be zero flaw. The focus on customer need, the focus on real risk actually gets sidelined, which should
Yes.
not happen. Now you look at all large exposures. Why just smaller NBFCs? Why not ICICI Bank, SBI, this Nirav Chokshi and all has not been funded by NBFCs, right? There are so many names. So
Yes.
mistakes have happened, mistakes will happen, but people just ensured that I should be 100% audit ready. My cam should be absolutely decorated and camouflaged in such a way that no one else can find a mistake and the case will go through. Now, this is what takes 30-40% of the brain time when a credit appraiser, and I'm talking of especially large ticket exposures when we are talking of mid corporate, large corporate. In smaller ticket loans, it's more or less process driven, so it doesn't happen, or maybe it happens, but the extent is lower. But for large ticket exposure, I think that's something which is where mostly all the credit heads, CROs of banks and NBFCs have gone wrong. Not that they have hidden something, but
Yeah.
only purpose. If your only purpose is decorating the cam so that someone else cannot find a mistake, or someone else cannot raise a question, then your intellect is actually spent on decorating or camouflaging that instead of looking at the right risk. This is one thing which I have seen very common.
This is very common across the industries in India.
I'm sure it is. Yeah.
So, we'll talk a little bit about technology and automation, sir. Like, you have implemented underwriting automation, rule engines, and AI-based scorecards. So, where has technology, genuinely improved credit outcomes? And what is that where human judgment is still irreplaceable?
See, there are two aspects of technology. One is the availability, accessibility of data. Like till maybe 2017 or 18, a bank statement which used to come from the customer had to be analyzed, had to be read through each and every entry, had to be checked by credit guys. No, who is making the payment? What today we have beautiful banking software analyzers available, like a Perfios or Noble Pattern, or there are many, Scorby, and there are many. In fact, today at least 20 such tech providers are available. Now that is giving you only the data, right? Getting the data through tech is absolutely fine. Getting GST data, getting bank statement, top 10 buyers, top 10 sellers, top 10 buyer as per GST, as per balance sheet, triangulating all that information into one, taking a conscious decision that yes, this data is valid, right? Data accessibility and availability is something that technology should do, my personal belief. But the decision making, second aspect is the decision making. Today you must have heard about those jokes. All CEOs want AI. Yes, we want AI. What will you do with AI? I don't know. Now, uh, sorry about that, but data is there. Are we matured enough to understand that data? Are we matured enough? Are we, or the data itself, has it stabilized? Way back in Standard Chartered Bank, when this Basel II norms and those norms were getting implemented across countries, one guy told me a very interesting thing, that there's something called a A score and then there's something called a B score. I said, A, B score. What is A and what is B? Tell me, please. So A score is what is the application score. Now let's assume a new bank, just for the namesake, I'm taking, let's say Bank of Russia comes into India, right? They have their database, their customer behavior, which is based out of Russia, but not in India, right? So A score today ideally should be talking about the demography of the customer, income bracket, age bracket, his past credit experience. But B score is what happens after you have onboarded the customer,
Right.
over the period of next 5 year, 10 year, customer actual behavior after you have on board. So the A score, B score are were still were used maybe after Basel. Even today they are used. My point is, we I mean, while we are all banks and all large institutions are looking at it and giving it a particular weightage in terms of pricing, RAROC or whatever. But are we doing the actual underlying monitoring activity which is supposed to be done? Every time you plan that you will have two concurrent audit people in next year budget, maybe 1, 2, 3 people for monitoring, for early warning signals. When the budget actually is getting prepared, either we are not able to fight it with the board, that saying that no, this cost is also important because it is going to shape up your portfolio in the long run, or we simply prioritize, nahi yaar, let's take two more underwriters so that transaction moves faster and better. There is
Yes.
no mistake in camps. and whatever will happen of the portfolio will figure it out. Now that attitude is not correct, and that prioritization has to come from the CRO or the CCO only. That even if you have maybe one or two appraiser or underwriter lower, but these are aspects which are far more important. So today technology is giving you a lot of insights from alternative sources. In UGRO or some other organizations, what we saw was that now a GST number is available, right?
Yes.
While onboarding, you are taking a GST number. Similarly, a Bijli ka bill is also being taken, right? The electricity bill. Now, electricity bill has a CA number, which is the customer account number. If you go back and pull out the data of CA number, maybe you will, maybe not, you will be able to see that what is his electricity usage for the last 12 months. Going forward, every month you can have a electricity usage from that CA number. If you keep tracking that, then you probably don't need to track their bank account, because for a manufacturer, if his electricity bill consumption is going up, then he is manufacturing more and more, so he's doing healthy, isn't it? Similarly, for a GST kind of, while GST every month, if you need to check their
Yes.
top line and bottom line, you still require a one-time password from the customer. If it's not available, at least you can go back and check whether the GST filing is happening or not.
Yes.
30% of your EWS. So these kind of data points are available. I'm wondering when RBI will allow the discoms, not the discoms, the telecoms to share their data, because today I get a message for everything. 5 rupees tax, GST paid, I'm getting a credit. If I can just analyze those SMSs, right, I can get all that data, isn't it?
Yes.
Taxes paid, electricity bill, credit card. I don't need to then do a CIBIL and bank statement analysis. But yes, there are other challenges. Hence, the regulator is not allowing it as of now. But these are things which are going to come. I'm sure government will find out a way, or things will start moving in that direction, so that the data, alternative data, is now really available and can be timely used. So coming back to your point, automation and this thing is absolutely necessary in terms of data collection, data analyzing, but decision making should be with people, because the world is changing, right? Nothing is stabilized. Today you might see that, okay, this pattern of customers or this income bracket is behaving this way, but tomorrow it might change. So that human aspect will remain largely. The number of people taking that call might reduce from a 500 to a maybe 5, because there will be 4 or 5 people on the top sitting and changing those rule engines. But yes, automation, 80% is like data collection and data analyzing, that AI and everything can do. But application and decision making, end of the day, should be human largely, until and unless they are 100% stabilized. So today a credit card, I think, is absolutely stabilized, or a personal loan is absolutely stabilized. But if you're moving from a normal mortgage business to affordable housing sector, or a, what they say, a smaller ticket lap loans, micro loans and stuff, then the game is completely different.
Yes.
So it's a process of evolution in terms of data availability and the ability to analyze that data.
Yes. This is very insightful, sir. I think these guys are not using those datas right now, and the GST thing which you talked about, then you talked about electricity bill. All these are considered to be secondary data while they are giving loans. But I think
So
if
people have started using it. It's not that nobody is using, but yeah, Smart a lot has started using it. See, discipline is something that comes at a cost, right? So you need to have people to do that. If you give just give the guy who is doing appraisal to of this extra activity, he may not be so much interested, and he might not do it as diligently as a separate resource would do it. Hence, I'm saying that these functions, and during budgeting, having the right people in the right place is of paramount importance.
so when we talk about lending, so we talk about turnaround time, which is a very critical lever. So how
Right.
did you balance faster TATs with portfolio quality?
So again, like I said, that data faster turnaround can happen by two ways. Either you make the decision making fast, or
Yeah.
you make the data availability fast. Data availability fast has already happened. Turnaround times have drastically come down from, earlier it used to take 5 days, 10 days for a home loan to get processed. But today it's like the data is available within 1 hour or 2 hour maximum. But
Yes.
yes, the decision making will take some more time.
Yes.
So what I ensured, and that's how probably we have sailed through pretty well in terms of managing our NPAs or managing our ECL, is that
Yes.
the data availability was done through system and tech. Decision making, dire dire we kind of experimented that if out of 200 loans, 150 has the same deviation. A customer doesn't have his rent agreement. So obviously rent agreement is either dated or there is some reason he doesn't have it. Remove that deviation, right?
Mm.
Or he's living in a area which is not so great, but you have already funded hundreds of customers from that particular pocket. Their behavior is fine. Data is stabilized now. Now do away with these deviations. But decision making has two aspects, and the second aspect which is necessary to ensure that your portfolio quality remains good in spite of a lower tat is that you believe on that data only once it has sufficient weightage, right, in terms
Yes.
of number of accounts, vintage, everything. So
Yes.
yeah, that's how I think.
Else there will be sampling bias, sir.
Ha, absolutely. So those biases keep coming. I mean, that's very frequent.
Sir, supply chain finance and MSME lending are usually considered to be low risk, with anchors. So, what do you think are the risks that leaders frequently underestimate, especially in these portfolios?
Now, what I've seen in the last 15-20 years is you have onboarded an anchor. So in supply chain, how it works is you identify a large corporate, let's say Tata Steel. Okay.
Hmm.
Tata Steel has at least maybe 5,000 or
Yes.
7,000 dealers. You fund their dealer ecosystem at one end.
Hmm.
Then Tata Steel might have again 5,000-6,000 small big vendors. You fund their ecosystem. Now once you have established this on the at a program level,
Hmm.
Tata Steel has become your anchor now, right? You
Yes.
are getting captive information, how much monthly sale, how monthly purchase these guys are doing, and based on that you are taking a call, giving them money. After 1 year or 2 year, then you suddenly become complacent. Oh yeah, Tata Steel, everything is good. Just
Ah,
close your eyes. Keep it moving. People
yes.
don't monitor. People don't go back to the relationship which was originally there. So every transaction, every supply chain business is primarily dependent on the relationship. If you are not talking, if your relationship manager, if your credit guys are not talking to the anchor on a regularized, planned manner, then you don't get even to know that okay, Tata Steel had already closed this dealer maybe 3 months back. Now I
Yes.
had
Yes.
made a payment to God knows whom, and still this account is running. So that relationship angle and that monitoring angle both are important. Mostly people have suffered in this business because they have become complacent and left the monitoring leg or the relationship angle. So timely, I ensure that people who are managing these relationships should maintain a credit diary every, if not every month, every quarter. What is the discussion with the anchor? How things are shaping up in the actual market? Which dealers are going to do well? Which dealers are not doing so well? If you know that these four dealers, five dealers are not doing so well, you should ideally slowly reduce their limits and make an exit. So
Right.
that angle is missing, I would say. People only plan and budget for people who can source or people who can underwrite. Other functions are kind of neglected. So there's a risk guy who is sitting, who is probably telling you, see, the peer numbers are looking different now. I mean, when we onboarded this anchor or the dealers, the peer numbers were completely different. Today peer numbers are no, everything is running fine. Why look at peer numbers? But if there are indicators, please look at those indicators. I think while people look at the bounce or 0 to 30 DPD as a key indicator, I think
Yes.
even before that, the early warning signals start coming. If you see a lot of customer complaints, then the customer is not happy with your operations, with your system. He would at some point of time be frustrated and may take a very strange call of even defaulting with you. So these when products are designed, you should leave one room for the customer escape also.
Yes.
I'll tell you what. Let's say entire industry is doing a lap loan against property. Everybody is saying, see, those guys, they have started doing 80% LTV, 85% ho gaya, 90%. Then what? You will do 120%. Some people are also talking of 120%. But doing that, you are not giving customer any route to exit. I mean, see,
Hmm.
initially the account will start bouncing, right?
Hmm.
Talking of a normal lab loan
Yes.
or maybe a machine finance loan. For a couple of months, the customer will bounce. You will go, your collection guy will go, understand what is the problem, do a formal, what they say, root cause analysis, RCA, and submit it to his boss, a good mark, 10 marks added in his appraisal.
Yes.
But if the bouncing has started, right,
Yes.
and the customer doesn't have any escape route, all these RCA, all this reporting, all this monitoring is not going to give you anything. Had you given him a shorter tenure loan, right? Let's say the property value is 20 lakh and you had given him 15 lakh for 5 years only. He can always go out in the market and say, see, at that point of time, my cash flows were different. Now, you give me a top up of 2 lakh and make this 5-year loan into a 10-year loan. He has an exit, right?
God. Yes.
PL, machine finance, everything. You need to think at the time of the product designing itself that what is the exit that you are giving to the customer. Today,
Yes.
we are not, I have seen, product guys not doing it. So that's something very critical.
That's very insightful, sir, actually. So when we talk about co-lending, BC models and partnerships, they are growing very rapidly. From a
Right.
credit lens, sir, what must lenders get right to avoid hidden risk accumulation?
See, first thing in co-lending is a relationship which is built upon trust. Now let's say there's a large bank and there are 5 NBFCs who are doing business, regular business, 100 crore, 200 crore, 500 crore. People start taking things lightly, that because okay, the top line has started happening. Now we will see how the portfolio behaves. Portfolio will behave only good once you have ensured that what you would have done on your own books, are you onboarding the same level of good customers via co-lending? So there are two aspects. One is that your underwriting has to happen in sync with the NBFC who is sourcing that business. If their guy is doing a PD, why can't you do a PD, or at least look at the PD video, look at the shop pictures? Then you'll also get to know, because guy who is sitting at the senior lender level has seen all that underwriting. If there is a Karyana ka dukan also, by seeing a photo and by seeing, they can make out how big is it. People are not doing that. So that trust, I would say, surpasses the underwriting procedures. That's when things go wrong. And then, of course, the monitoring activity. Again, I would say that if you are doing if you are into a relationship, co-lending relationship with any smaller organization entity, and they are doing 100 cases with you, why don't you also do 10 or 15 sample visits along with the sourcing partner?
Yes.
If you keep doing that, then I think the underwriting parameters more or less remains the same. See, one underwriting parameters has again two things. One is the paper work, right? Paper, we all know, may be believed, may not be believed, but having a cross visit, having a joint visit with both the lenders and the customer actually changes a lot. So that trust has a limit.
Yes.
You have to trust him, because otherwise the business will not happen. Apart from the trust, you need to do these homeworks, keep visiting his cases, keep talking to their customers. Then only things will be under control on the retail side.
And you have also overseen ECLs, like the early bucket collections and portfolio monitoring as well. So, what early warning signals should credit heads never ignore, especially in volatile cycles?
See, early warning signals, so far as the conventional credit fraternity, what they look at, the conventional things like, sales is getting down, there's a management change, or there's a CFO change, or there's a bounce that is happening, or there's a delay in a DPD. Those are very bookish things, and you must do that. I mean, those are, they cannot be neglected. Keep doing it. But please understand that is ECL an activity which where the owner is only the CRO or the CCO? No. See, ECL has primarily two aspects. One is the probability of default, right? If I have onboarded 200 customers, out of them, how many are good, how many are bad in A score, right?
Yes. Yes.
PD, probability of default, into LGD. How much have you how much loss you had to take when these accounts went bad? That is called LGD. PD into LGD is equal to ECL grossly. So if some organization is sourcing bad, right? He's sourcing a civil below 675 or below 700. He's selecting profiles which have like below 20,000 income. He's selecting properties which are not prime. And you keep doing those same things and expect the CCO or the CRO to take care of your ECL, then it is not going to work. So my way of managing the ECL in the best way is that there has to be absolute transparency with the sales team, with the collection team. You need to tell the collection guy why all the collections happen between January to March, because
Yes.
there is no choice left. So whatever loss could be taken, please let us
Yes.
take all that loss. This is wrong. Then you are setting the wrong precedent, because in doing whatever can be done, you will take maybe a 20-25%, and that becomes history for yourself, right? So next time when you go for an LGD calculation, your auditor will say, see, last year you had done all the settlements at 20-25%. How can you project a 10% settlement loss?
Yes.
So that alignment between business, between collection team, and of course the CRO or the CCO is the owner of the ECL. ECL is just again a plus B whole square plus A, right? That's a formula. People do it slightly differently, but grossly what remains is PD and LGD. Now PD and LGD cannot happen right or cannot be lowered till the time there is an absolute alignment with business, the sourcing teams and the collection teams, because you need to make sure that whatever you are going to source will affect your PD, and the way you are collecting will affect your LGD. So that kind of alignment, once it is there, these EWS and other things automatically, sink in, and you end up having a lower credit loss.
So how to create such kind of an alignment, sir? Like what are?
See, there are organizations. I have spent many years in Hero or UGRO or DMI or Tata Capital, explaining people that how is it going to affect you. So in 8 hours of duty, everyone is not working for end-to-end 8 hours, right? There are times, there are focused, time slots that credit heads and risk heads have to pull out in discussing these things with people. If you make people understand, the business heads, regional heads, their area heads, you keep doing it every quarter, every month, not every month, but at least once in a quarter, half yearly, you keep showing them that this is how your ECL is shaping up because of what you are sourcing or because of the way you are collecting. That's the only way. And communication, transparency can make people understand what is ECL. Today, you look at any small NBFC people, sales or credit, ECL, many of them even haven't heard of it.
Exactly.
Why?
Yes.
I would say that's a wrong, organization culture.
Yes.
That culture has to change. That culture has to be owned up by the risk head or the credit head. That's the way to change it.
Yes. So also looking at today's macro uncertainty, how should credit leaders rethink risk frameworks without becoming overly conservative?
Very interesting question. And I keep saying my credit team that Albert Einstein said, E is equal to MC square, right? Some still remember, some don't even remember. Especially the MBAs and CAs. E is equal to MC square. I heard something over. People need to know E is equal to MC square was written at least 100 years back, or maybe 120, whatever. I'm sorry, I'm bad in that. But that's a formula. Then there's a delta in between that people have forgotten. That wherever situations come up, every manager has to handle that particular situation differently. So keep your eyes and ears open. Nothing is stabilized. No formula will remain good forever, because the world, the dynamics, economic scenario, global scenario, everything is changing. Every day it is changing. So till the time you do not keep your eyes and ears open, you do not keep learning, you will not be able to manage that delta. MC square to same hi rahega. Nothing will change. So my view is that meet more and more customers, keep your eyes and ears open in terms of demography changes, what are happening, political changes that are happening, geopolitical changes that are happening, industry changes. Data is available, like huge data is available. All these rating agencies, ICRA, CARE, they have very large models across industries, how these industries are shaping up. So keep your eyes and ears open and remain focused, remain open to learn. I think that's the only way.
There's an interesting question, sir. Like, when you started your career, you may be having a belief about credit or risk management that you strongly hold, but now it has changed with experience.
Yes. So, we all learn with the flow, right? Learning with the flow is good in most of the jobs. But credit and risk, I think if I could have documented each and every thing that I have learned today maybe it would have been a big help for people who are getting into this industry, into these kind of roles, so that documentation of learnings, while all organizations have somewhere created a drive, learning hai, training ho raha hai, but other day everybody is forgetting. I think that culture of sharing the knowledge, that culture of capturing the knowledge, because if you look at any organization, there are lakhs of people working in Tata Capital today, maybe 6,000, 8,000, how many people are working, and they have been working for 20 years, so many man hours of experience is there. But I still feel organizations have not been able to store that level of data, accurate data. If not accuracy, at least organizations should have started thinking in those lines, that the learning of so many people should have been stored, and I should have at least personally stored my learnings somewhere. Because if any organization could have done that, imagine what kind of an organization, what kind of a learning SBI or a HDFC bank today have.
Yes.
So organizations are spending so much on training and development, tools develop. The way we are spending to capture this kind of data and store it is maybe wrong. We are still, what they say, democratically allowing people to share their experience. But
Yes.
if you have a structured format that, okay, this guy had learned this and this is how things went good or went bad, I think that would have created a lot more, not just for any organization, but for the histories and other lenders as well. And see, there are two kind of data that those can be sold.
Yes.
Is where you know who is going to buy what. Second is, of course, knowledge. Knowledge is very costly. I mean, we
Yes.
have spent 50, 60 years by now, post freedom Indian banking system and everything. But this kind of data storage, or having a module, having a thought process to capture all that data, I don't think still organizations are spending on it because of whatever reason. But yes, had that been there, we could have had a huge database of learning. And
Yes.
this AI, whatever they are using these kind of learnings only, right? So if you had 10 such instances that where what was done, what went right, what went wrong,
Yes.
then things would have been completely different.
Now, finally, sir, for all the professionals who are aspiring to become chief credit or risk officers, what are the capabilities do you think differentiates a successful leader over the next decade?
See, even today, I don't see a formal degree coming in banking. There is nothing called a bank manager MBA or
Yes. But, sir, one of the institute had started. I will not name that
no,
institute.
NIBM has it. Maybe there are a couple of more institutes who
Manipal
are
also.
doing this focused activity. I think common sense is very uncommon,
Yes. Yes.
and
Yes.
banking is mostly about common sense. These RBI guidelines and everything, your boss will anyways teach you within the first 6 months or 1 year. Don't get worried about that. But the common sense, that what is exactly the usage, what exactly is the need, is something that every aspiring candidate has to possess. And to have that common sense, you just need to question, go back. And when I used to meet customers, even today I meet a lot of customers, small customer balance sheet is not so good, right?
Yes.
Civil also is like, okay, his intent is established, but his repayment ability is maybe not established. And this guy comes and tells me that I need this loan of 1 crore for 5 years. I said, see, for 5 years, I cannot trust your business. Maybe I don't believe that you will keep generating so much of cash for 5 years. Are you okay taking it for 2 years?
Hmm.
Guy tells me, yes, I'm also fine with 2 years. Then he has business in hand, right? He has enough cash flows in hand, and that's a good customer for me. But anybody who keeps fighting with me, no, I want it for 5 years only, that means that he doesn't have business in hand and he needs elongated, cycle to repay the loan. That's a bad customer for me, even if his paper is good. So this is nothing but common sense.
Yes.
A machine finance customer will never come for a show off. People take loans to buy properties, to show off people, gadi, jewelry. But for a industrial machine,
Yes.
nobody will do a show off, right? If he's ready to take a loan for a smaller tenure, that's where you should understand. Then you will go back and see, okay, you tell me how will you repay this loan in 2 years? He will come back and tell you. He has that back of the envelope calculation with him.
Yes.
And he will immediately tell you, see, I'm doing this, I'm doing that. Per day, I'm saving this. Per month, I'll save this. Hence, I'm okay paying this EMI. The moment you reach to that calculation, which no
Right.
degree can give you, right?
Yes.
No degree can give you, because that guy calculation is known best by that guy.
Yes.
If you can map his cash flows with his requirement, that's common sense, and that's the only way to do credit. While repayment intent and everything today can be established looking at civil or bureau of largely your capacity also can be looked at from banking and other balance sheet items, but that kind of an understanding of business which the promoter has should also be there with any credit appraiser who aspires to grow up, because in your first 15 years you will meet some 2000 such customers, and then anyone who is going to fool you saying that plastic injection molding has 20% margin, you will
Ah,
say, "Chal,
yeah.
I have seen so many, it's not like that." So that kind of continuous interaction, keeping your eyes ears open with the with the market, with the movements, with the changes that is happening, those are happening, is important, I feel.
Thank you so much, sir. I must say, very insightful discussion. And the best part among this was that the practical examples that we took and made our audience understand it in a very, 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 kind of layman terms. Thank you so much, sir, for taking our time and sharing all these insights for us. We look forward to hosting you again.
Sure, Rishikesh, thanks for giving me this opportunity. I would say Dawdle is a big name, and going bigger maybe very soon. So thank you,
Thank you so
and nice talking to you.